Have you ever seen a stock just plummet after one little piece of bad news and think to yourself, wow, isn't that a bit much? Or maybe you've seen one go to the moon and wondered if the hype is actually real. Well, today, that's exactly the question we're digging into. Does the stock market overreact?
All right, so let's get into it. For the longest time, the main idea in finance was that the market is this perfect, cold, calculating machine. A place where every single decision is totally logical and every price reflects all the information out there instantly and perfectly.
And this idea, it has a name, the efficient market hypothesis. A huge part of this theory is that you just can't use what a stock did in the past to predict what it's going to do in the future. Why? Because the market, in theory, has already priced everything in. It's supposed to be perfectly efficient, with zero memory and absolutely no emotion.
But is that really how the world works? Let's pull back the curtain on what we could call the market's rational myth.
It turns out, people have been questioning this idea of a perfectly rational market for a long, long time. I mean, all the way back in the 1930s, the famous economist John Maynard Keynes was already pointing out that the market's reaction to daily news was often, in his words, excessive and even absurd.
And this leads us to a completely different idea, one that comes more from psychology. It's called the overreaction hypothesis. And it's pretty simple. It suggests that we humans, the people who are actually doing the buying and selling, we tend to overreact. We get way too pessimistic when there's bad news and way too optimistic with good news, and we end up pushing prices far beyond where they should logically be.
So, let's explore this very human glitch, this tendency to overreact, and see how it might just explain some of the market's so-called absurd behavior.
So in 1985, two researchers, Werner de Bont and Richard Thaler, a name you might have heard of, they decided to stop just talking about it and actually put this glitch to the test. They came up with a really clever study to see if overreaction was a real, measurable thing in the stock market.
And the way they did it was frankly brilliant. They basically set up what you could think of as the ultimate stock showdown.
Okay, so here's how it worked, and it was so elegant in its simplicity. They took over 50 years of stock market data, and for every 3-year stretch, they picked out the absolute best performing stocks and the absolute worst performing stocks. Then came the most important part. They just sat back and tracked how those two groups performed over the next 3 years.
So let's meet our contenders. In one corner, you've got the winner portfolio. These are the market darlings, the stocks everyone loves and can't stop talking about. And in the other corner, you have the loser portfolio. These are the forgotten stocks, the ones that got absolutely hammered by bad news and terrible performance.
So here's the big question. After all that sorting, who do you think came out on top in the next round? Was it the champions that everyone was betting on? Or was it the underdogs that everyone had completely written off? Now, traditional thinking, that old efficient market hypothesis, it would say there shouldn't be any predictable difference at all. But what do you think actually happened?
Well, what de Bont and Thaler discovered was so shocking it actually got a name, the Great Performance Reversal.
The results were just stunning. Over the next 3 years, that portfolio of winners actually underperformed the market by about 5%. But the loser portfolio? Oh, it didn't just bounce back. It totally crushed it, outperforming the market by a massive 19.6%. The underdogs won, and they won big time.
When you add it all up, that's a mind-boggling 24.6% performance gap between the forgotten stocks and the market darlings. This result just completely flew in the face of efficient market theory.
But hold on, the story gets even weirder. When the researchers really dug into the numbers, they found a really bizarre pattern in when these loser stocks were making their incredible comeback. It wasn't some slow and steady climb.
Not at all. It turns out a huge chunk of their outperformance was consistently packed into one specific month, January. For some reason, these loser stocks would just have these massive returns right at the start of the year over and over again. And this wasn't some fluke. This January effect was so incredibly persistent that de Bont and Thaler could still see it happening 5 full years after they first put the portfolios together. Something really systematic was going on here.
So, what does this all mean? Let's zoom out and look at why this one idea, this one study, really helped reshape modern finance. This is where it all comes together. On one side, you have the established theories. Market efficiency says past prices can't predict the future. But this study showed, well, actually, they can. Past losers predictably beat past winners.
Classic finance theory also says to get higher returns, you have to take on higher risk. But here, the loser portfolio was actually less risky than the winner portfolio, and it still produced way higher returns. The data was a direct challenge to the core ideas of finance.
So what's the big takeaway here? This study gave us some of the first real, powerful evidence of what experts call weak form market inefficiency. It was also a huge moment for a whole new field called behavioral finance, which mixes psychology with economics. It's influenced generations of value investors, the ones who hunt for these oversold, forgotten stocks. But maybe the biggest lesson is just a simple reminder. Behind all the fancy charts and algorithms, markets are, at the end of the day, driven by people.
And that kind of leaves us with one last thought. The next time you see a screaming headline about some stock that's soaring or crashing, just take a second and ask yourself, is the market rationally processing new information, or is it just having a very, very human overreaction?